22 years. I mean, I just really want you to sit with that time frame for a second. 22
This
years.
is a massive amount of time.
Right. Like, imagine buying a new fridge today, or taking your family out for a really nice dinner, or maybe covering just a single emergency car repair.
Yeah.
And then you are still actively paying for that exact same purchase in the year 2048.
It sounds so extreme, right? Like it has to be some wild edge case, or maybe the result of someone just completely ignoring their bill.
Exactly. Like, massive mistakes. But it's not.
No, it isn't.
Yeah.
It is just pure, simple math
Uh.
based on the standard terms of modern debt that so many of us use every single day.
And that is the quiet, jarring reality we are doing a deep dive into today. Because that 22-year sentence, it mostly happens when you do exactly what the statement asks you to do.
Right.
When you pay the exact minimum due. And there is this core tension, this real contradiction that I think so many of us feel every single month when we look at our screens.
Oh, absolutely.
Paying that minimum, it feels like the responsible choice, you know?
It does. It feels like you are checking the box.
Yeah. You get the bill, you pay the number in that little square, your account stays in good standing, you don't get any late fees. It just feels like you are managing the issue.
It feels safe. And I want to be really clear about this. That feeling of safety is entirely by design.
Wait, really? By design?
Yes. Our mission in this deep dive is to gently pull back the curtain on this. We're going to unpack the hidden math and mostly the human nature behind this specific trap.
Okay.
We want to explore why this number is engineered, literally built to keep you paying for as long as mathematically possible. And then we will look at the simple daily steps to just break that loop for good.
So we are essentially looking at a system where the official number printed on the statement, the one the bank highlights for you in bold, is not actually designed to get you out of debt.
No, it is not.
It is like a doctor giving you medicine that just manages the symptoms forever, so you never actually cure the illness and you just keep buying the medicine.
That is a perfect way to put it. The underlying condition just keeps making money for the lender.
Let's look at the actual blueprint of this trap, right? The mechanics of that minimum due.
Yeah, how do they even come up with that number?
Well, the standard formula most issuers use to work out your minimum payment is just shockingly small.
How small?
It is mostly calculated as a tiny slice of your total balance, usually just 1 or 2% plus that month's interest charges and any little fees.
Okay, let's walk through what that actually looks like in real life.
Yeah.
Let's say you have a balance of $5,000.
A very normal amount for a lot of people.
Right. Very common. When you get your statement, the minimum payment for that might look really manageable. It might be around $100 to $140.
Right.
And at a quick glance, you probably think, okay, I can swing that. I don't have to change my budget.
But what the statement doesn't make perfectly clear is the ratio of where that $140 is actually going.
What do you mean? Well, when you first start carrying a balance, maybe 60 to 70% of that minimum payment is just instantly eaten by interest.
Wait, so it never even touches the $5,000?
Hardly at all. If you send in $140, nearly $100 of that might just be the pure cost of carrying the debt for the last 30 days.
Wow.
You are essentially just renting your own balance.
Renting your balance, that is such a heavy way to think about it. So you are paying every single month, but you are literally trying to run up a downward escalator.
Yes, that is exactly what it feels like.
And that escalator is moving against you at a 22% speed. You sweat, you put in a massive amount of effort, but you only move one tiny step forward because the floor is just dragging you backward.
And if we zoom out and look at the whole country, the speed of that escalator is speeding up.
Yeah, I feel like interest rates are just everywhere right now.
They are. Total consumer credit card debt has crossed the $1 trillion mark. At the same time, average interest rates have climbed well past 20%.
$1 trillion.
Yes. This isn't just a simple mistake people are making with their budget. It is a massive, system-wide transfer of wealth.
Let's talk about those interest rates for a second, because I think I have always had a deep misunderstanding about how this debt works compared to other loans.
How so?
Well, like if I have a car loan at 6%, I kind of intuitively grasp what that costs me. I get a car, I pay a little extra for the loan, but 22%, why is the gap so huge?
It comes down to how banks view risk. Credit card debt is completely unsecured.
Meaning there's no house or car attached to it.
Exactly. Because there is no physical item for the bank to take back if you stop paying lenders' price in these massive failure rates across everyone they lend to.
Oh, I see.
You are effectively paying for everyone else in the system who doesn't pay their bill. through your own 22% rate.
So if the math is this structurally terrible for us and the downward escalator is this obvious once you actually look at the numbers, why do so many incredibly smart, totally capable people fall for it?
That is the big question, right?
Mm.
And it is where human nature comes in. When you look closely at how people deal with money, you see these distinct mental tripwires that make the minimum due almost impossible for the human brain to ignore.
Okay, so if I am looking at my screen, right, I log into my bank app, what is the very first mental tripwire I am hitting?
The first one is a concept known as the anchor effect.
The anchor effect.
Yeah. In our minds, our brains tend to latch on to the very first specific piece of number data we are given. That becomes the anchor. And then we adjust all our other choices around that one number.
How does that actually play out with a credit card bill, though?
Think about it like this. When people are shown a bill with a total balance but no minimum payment listed at all, they tend to pay a really good chunk of it.
Because they just look at the total and think, I should pay this down.
Right. But if you show someone the exact same total balance, but with the specific, really low minimum payment printed right at the bottom, they end up paying way, way less toward their actual debt.
So the very fact that the loan number is printed there pulls their choice downward.
It does, like a magnet.
Even if they had, say, $500 just sitting in their checking account and they fully plan to pay a big chunk of the debt, they see minimum due, $35, and suddenly they think, oh, maybe I'll just pay $50 and keep the rest.
Exactly. The anchor resets their baseline of what feels like a good or a safe payment, which leads right into the second tripwire, the default choice.
Default choice, like on a computer.
Exactly like that. Human beings will almost always follow the path of least resistance when it is presented to them.
We are lazy.
We are busy. And the minimum due is physically presented on the screen, whether it is a paper bill or your phone app, as the default setting for your monthly duty.
This sounds exactly, perfect, like the default tip screens at a local coffee shop.
Oh, that is a brilliant way to look at it. Tell me more.
You know, you buy a simple drip coffee, they spin the little tablet around, and if the screen suggests 20% tip as the bold default option, you just tap it.
You do.
Because it requires zero brain power. You don't have to do math. It is the path of least resistance.
Yes.
So the banking app is using that exact same default psychology, but instead of costing you an extra $1 for a latte, clicking the default pay minimum button is costing you thousands of dollars over a decade.
And you tap it because the default is designed by the company that benefits from it.
Oh, that's dark.
Well, think about it. If the default was truly designed to benefit you, the suggested payment button would be the exact amount required to avoid any interest charges at all.
Like pay full balance would be the big green button.
Right. But it isn't. The minimum is the big button. And we accept this setup because of the third mental trap. It is called present bias.
Present bias. Let me guess. We care a whole lot more about having cash in our pocket today than we care about losing cash tomorrow.
We do, but it is even stronger than just a preference. Present bias is our hardwired nature to heavily overvalue today's comfort against tomorrow's pain.
Like eating a donut today versus going to the gym tomorrow.
Exactly. A small, easy minimum payment feels so incredibly appealing to your budget this afternoon. You think, great, I still have money for dinner.
Yeah.
But the vague idea of paying $3,000 in interest 5 years from now, your brain simply cannot picture the pain of that future cost, so it just ignores it entirely.
It is a perfect mental storm. You have the anchor pulling your payment down, the app making the minimum the easiest button to press, and your own brain telling you to protect your cash today at all costs.
And the total result of these three traps coming together is just huge. It is a common pattern that a really large number of people who always make only minimum payments end up paying way more in pure interest over the years than the actual amount they borrowed in the first place.
You essentially buy the item twice, or even 3 times.
Yes.
Let's ground this in a real-world math example because the timeline here is super sobering.
Let's do it.
Let's say you have a $4,000 balance, and you are at a 22% interest rate.
Very standard.
If your minimum due is worked out at 2%, that is about $80 a month.
Okay.
If you pay exactly that $80 and not a single penny more, it takes over 11 years to clear the balance. And the interest alone will cost you over $3,000.
But look at what happens to the math. If you spot the mental anchor and you actively choose to break it.
What happens?
If you completely ignore that $80 default button and you decide your new personal minimum is, say, $200 a month,
Okay, so you bump it up.
The payoff timeline collapses from over 11 years down to under 2 years.
Under 2 years.
Yes, and the total interest drops from over $3,000 to just a few hundred.
Same initial balance. Same punishing interest rate.
The only thing that changed was rejecting their anchor and setting your own.
That is wild.
I see this exact story play out so often. Let me tell you about a situation that really shows how sneaky this trap is, even when you think you are doing everything right. I often think of people like Jennifer. 31 years old, works in marketing. She always prided herself on being super responsible with money.
She pays her bills on time.
Exactly.
Yeah.
Well, she had an unexpected $5,000 car repair, and she had to put it on her card.
A transmission or something. That hurts.
It does. But for 18 straight months, she paid the minimum due without missing a single payment. Not one. She felt really good about it. She felt she was managing the debt perfectly.
Because the bank kept sending her thank you emails for paying on time?
Exactly. But when she finally sat down and looked closely at her actual total balance a year and a half later, it had only dropped by $400.
18 months of always making payments, and she only chipped away $400
Yes.
because she was carrying a balance, meaning the interest was growing on her daily total every single day. She was basically shoveling her hard-earned money straight into a furnace.
She was. And her big wake-up call only came when she finally looked past the minimum due box on the screen, and she found the payoff timeline at the bottom of her statement.
What did it say?
She realized it would take her well past her mid-30s to pay off a single car repair that happened in her 20s.
Oh, that is so heavy. And that brings up a really important point about the myths keeping people stuck on this downward escalator.
There are so many myths.
Because we tell ourselves these stories, right, to justify carrying these balances. Like
Yeah.
the incredibly common myth that paying the exact minimum is actually the best way to protect your credit score.
Oh, I hear that one all the time.
People say the banks want to see a long, slow history of payments.
That is one of the most expensive misunderstandings in the whole money world.
Really? That's not true.
While it is true that always paying on time is good for your score, another massive piece of the puzzle is your credit usage ratio.
What is that?
It is simply how much of your total allowed credit you're actively using. Carrying a high balance month after month keeps your usage ratio artificially high.
And that is bad.
Yes, it actually pushes your score down.
Yeah.
Aggressively paying down those balances is math-wise far, far better for your credit profile than dragging out tiny minimum payments for years.
Okay, so that is myth number one, busted. But there's another trap I really want to ask you about because it is everywhere. It is pitched as the ultimate hack for credit card debt.
I think I know what you're going to say. Balance transfers?
Yes, balance transfers, you see the ads constantly. If you are stuck, just open a new card with a 0% starter rate, move the debt over, and you beat the system. It sounds like magic.
A balance transfer can be a very helpful math tool, yes, but human nature-wise, it often causes a complete relapse.
A relapse, like falling back into bad habits.
Exactly. What you see happen so often is that someone transfers the balance,
Yeah.
and they feel this massive instant wave of relief because the interest charges just temporarily stop.
Pressure is totally off.
Right. But because their daily spending habits haven't actually changed, they just continue the exact same minimum payment routine on the new card.
Oh, no. So they haven't actually stopped running on the downward escalator at all.
No.
They just hit the pause button on the escalator for 12 months, took a nice little nap on it, and then it is going to start moving backward again.
That is exactly what happens. The special 0% time limit expires. The new card's default high interest rate kicks in, which is often even higher than the first card, and they have completely rebuilt the exact same trap just under a different bank's logo.
Wow. So a balance transfer is only a real fix if you use that quiet, no interest time to aggressively attack the main balance rather than just coasting on a smaller minimum.
Precisely. You have to use the pause to run up the stairs, not to rest.
Okay, so how do we actually flip the script here? Because if the math is working against us this hard and the mental tripwires are this deeply baked into the bank apps, how do you actually build an escape route?
The amazing thing about compounding math is that it has no feelings. It is entirely neutral.
Neutral.
Yes. It can work for you just as powerfully as it works against you. Once you see the system, you can reverse it.
Okay, give me an example.
Think about Robert's situation. He's 48, he has a mortgage, he has kids. He is right in the thick of peak daily money pressure.
Oh, yeah, the squeeze.
Exactly. He had carried a credit card balance for years, always just paying the minimum, always telling himself he would finally deal with it when he got his next raise at work.
The classic present bias response. Future Robert makes more money. Future Robert can easily handle
Right.
this.
Future Robert will save the day. But what finally broke his present bias was looking at his total interest paid for the year on his January bill.
The year-end summary.
Yes. He saw he was paying over $1,000 in pure interest every single year. It created an immediate real pain in his gut.
$1,000 of nothing, just renting the debt.
Exactly. So he didn't go on some extreme, crazy financial crash diet. He didn't sell his car or anything. He simply looked at his spending, cut a few forgotten streaming apps he never watched, and he found an extra $150 a month.
Just normal, everyday budget tweaks. And here's where it gets tactical, right? He didn't just sprinkle that extra money around on all his different bills.
No, he didn't. He directed that specific $150 exclusively to his credit card with the highest interest rate.
Ugh, that one mostly.
He used a method that works really well. Some people call it the avalanche method. By ruthlessly attacking the balance with the highest interest rate first, he stopped the fastest moving escalator.
Because that one was doing the most daily damage to him.
Right, and he cleared that high interest card in 2 years. But the true beauty of this method is what happens next.
What did he do?
Once that first card was fully paid off, he didn't just absorb that monthly payment back into his fund money.
He didn't inflate his lifestyle.
Exactly. He took the original minimum he was paying, plus the extra $150, and he rolled that entire combined amount into the payment for his next highest interest card.
Oh, so he built his own compounding momentum, like a snowball rolling down a hill?
Yes, exactly. And the thing is, it doesn't even require $150 to trigger this magic.
It doesn't.
No.
Yeah.
I know of another story, Chris. Chris had a $3,000 balance. All he did was add an extra $50 a month to his minimum payment.
$50? That is like skipping a takeout dinner twice a month.
Very doable. And that single $50 tweak collapsed his payoff time from almost 9 years down to under 3 years.
9 years to 3 years. Just from $50.
Because every single dollar of that extra 50 went directly to the actual debt.
Right.
It completely bypassed the interest fee.
Mm-hmm.
But Chris did something else that is highly critical here. He put that extra payment on auto pay.
He set it up to happen by itself.
Yes.
Because that instantly defeats the present bias we talked about earlier.
It does.
If you have to wake up every single month, log into the app, and make the active, painful choice to part with an extra $50, your brain will eventually find a really good excuse to keep the cash.
It will. Your car will make a weird rattling noise, or you will have a stressful week at work, and you will just default back to hitting the minimum button to feel safe. Setting it up on auto pay removes the mental burden. You make the brave decision exactly once, and you let the system carry it out month after month.
Okay, so to do this properly, you have to find your true anchor. We talked about how the bank uses the minimum due to anchor your mind to a low number.
Right.
So you have to locate the actual payoff estimate on your statement instead.
Yes. By law, card issuers have to show you a little box that says how long it will take to pay off the balance if you only make minimum payments, versus how much you need to pay to clear it in exactly 3 years.
So you find that specific 3-year payoff number, and you make that your brand new anchor.
You do.
You completely erase the minimum due box from your mind.
Just pretend it does not exist.
Yeah.
And while you are doing this, you have to stop the bleeding.
What do you mean?
You must halt all new spending on the cards you are actively trying to pay down.
Oh, right. Because of the grace period?
It's exactly. Credit cards generally lose their interest grace period once you carry a balance from month to month. That means every single new purchase you make begins adding interest the exact day you buy it.
So if I buy a $20 lunch, it starts growing at 22% that very afternoon.
Yes. You simply cannot outrun the interest if you keep adding fresh fuel to the fire.
Which means you also need a little safety net. Because if you throw every single spare dime at your debt, but you have zero cash in the bank, the very next time you get a flat tire, it goes right back on the high interest card.
And you lose your grace period all over again. Building a tiny safety buffer, even just saving $50 a month into a separate bank account, is what stops you from falling backward.
And there is one final move you can make, right? Something that attacks the math directly from the bank's side.
Yes, you can just pick up the phone and call the bank to lower the interest rate itself.
I think a lot of people assume those rates are carved in stone by the government or something.
They are influenced by the broader market, sure. But the final rate is totally controlled by the bank. If you have a decent history of paying on time, you actually have power.
Really? Just by asking?
Yes, simply calling the retention team, and asking for a rate drop can sometimes get your rate cut by several points.
Why would they do that?
Because they would rather earn slightly less interest from you than have you transfer the whole balance to a rival bank and earn nothing. Over a 2-year payoff plan, even a 3% drop in your rate changes the math hugely in your favor.
It really is a game of tiny steps. It is not about relying on pure willpower to starve yourself of any joy. It is about changing the dial just a tiny bit, locking it in with autopay, and letting time do the heavy lifting for you.
That is exactly it.
At first, it really doesn't look like you are going in a different direction. Your monthly budget feels basically the same, but give it 2 years, and because of that minor math shift, you end up in a completely different financial world.
That is the ultimate nature of compounding. It is quiet, it is incredibly slow at first, and then suddenly, it is completely undeniable.
Okay, let's bring everything together that we have unpacked today. If there is one specific thought we want you to walk away with from this deep dive, it is this. The minimum due is not a finish line.
No, it isn't.
It is a floor. It is a highly tuned setup designed by the lender, mostly to make money for the lender, but by understanding the mind trap of the anchor effect and the raw math of daily interest, you have the absolute power to just step off that escalator.
You really do.
And you do it simply by setting your own mental anchor, putting a slightly higher payment on autopay, and just refusing to accept their default setting.
And if we take a step back and connect this mental trap to your bigger picture, it raises a rather profound question for you to explore this week.
What is that?
We have seen exactly how the default minimum payment on a screen is built to work against you, to quietly, slowly drain value over decades. It makes you wonder, where else in your money life are you just blindly accepting the default setting?
Oh, that is a great point.
Whether it is your retirement fund rate that was auto-selected by your boss when you got hired, or the auto-renewing streaming apps you stopped using 6 months ago, or even the default data sharing choices on your banking apps, who really benefits from the default path you are walking on right now?
That is a phenomenal question to end on. Challenge the defaults.
These thoughts, these questions, they don't have to stop here. Money Geeks has many more podcasts and videos just like this one. Subscribe to the channel and explore other episodes. They all flow the same honest way. If this podcast felt genuinely useful to you, share with even one person in your life. That one share can bring a real change in someone's life, and it helps Money Geeks reach more people who truly need this. If this brought you real value, look for the Join button right next to the Money Geeks logo below this video. Click it and become a member of the Money Support Circle. Your support helps honest money awareness reach thousands who are silently struggling. Money Geeks moves forward because of you. Thank you so much from the heart for being here.